Sunday, August 28th, 11:34 a.m., New York time. Day trading options. Yep, specifically day trading options. Day trading, meaning you're in and out of the trade the same day. Options are a form of derivative. Options are one of many derivative financial instruments. I'm going to specifically talk about options that trade on the stock market. Those options trade from 9:30 a.m. to 4 p.m. New York time. And I'm going to discuss trading the options that expire the same day. The same day, referred to 0 DTE. And the specific symbol for this one is SPX. This is the S&P 500 index on the stock exchange. There's other S&P 500 financial instruments on different exchanges, different rules, policies. Yeah. So I select this one because this one has high liquidity, which is wonderful. Tight spreads, which is wonderful. That's a good thing. And it moves. That's a good thing. Not all brokers give you access to trade options. Yep. Some brokers require you to have different minimum balances. And there's different rules and regulations on different financial exchanges. So on the stock market, if you day trade any financial instrument in the equity market, that's another name for the equity market, stock market. So regardless if you're trading the stocks or the options in the equity market, day trading more than a certain amount of trades in a week, 5 trading days, you would have to have a higher margin amount. Yep. So if you're going to day trade on a regular basis full-time, you're most likely going to have 25,000 with your broker, unless they're playing some other games, because the Securities Exchange Commission regulates that. But you still day trade, but you're only permitted to do less of them. Yeah, less of them. This referred to PDT. Yep. You could research more of that from the Securities Exchange Commission. Looking at this financial instrument, the S&P 500 index, looking at a daily chart, yeah, to me, I rather include looking at charts as well too. Taking content, Friday, this one candle represents Friday, huge trading range, huge body. Yep. Huge, almost all body, almost no wick. The trend is down. So since the week already passed, I want to look at a full week. Look at a full week. Also full red candle. Trend is down. Now I'm going to look at a monthly. Well, the month is not over yet. We're much closer to the end of the month than the beginning of the month. But again, it's not done yet. Current candle is red. Yep, near the bottom. Let's go forward. Let's look at options now. So this is a desktop trading platform called Thinkorswim, owned by Charles Schwab. So here on this trading platform, you open up the option chain, buzzword, keyword, option chain. You see all these contracts, just like life insurance, health insurance. They have contracts, different expirations. Remember I said these are derivatives. Insurance is a derivative too. So on the left side of this trading platform, it shows a calendar day followed by the month and the year when it expires. In the brackets here, tells you how many trading days are left. Well, come Monday, when the market opens, this will say 0. Got it? So hence 0 DTE. Yep. Monday, this will expire. This will expire the 29th August 2022. Yep. So if it doesn't say 0 in it, obviously it's not expiring that same day. Again, the market's closed right now. This is not going to update till either late tonight or definitely tomorrow morning. So if you're going to trade this, that's a good thing. Well, not all options on all stocks have options. Okay. That's another good reason why I'm trading this, because it has options. Not all stocks that have options have contracts that expire every day. Well, this have contracts that expire every trading day. Monday, Tuesday, Wednesday, Thursday, Friday. Yep. 1, 2, 3, 4, 5. Yep. Beautiful. Okay. You used to not have that. Just recently, they started to have contracts expire every day. So every trading day, you could do 0 TE, 0 DTE. Next, I'm going to open up the contract. Now the contract I open is the one from Monday. Left side calls, right side puts. And down here is the strikes. Going forward, let's just take this for example. Friday, it closed at last trade 40.57. If I was bearish Friday, depends how aggressive you want to go. Okay, and if you want to do a minimum 2 strikes, well, I was just minimum 2 strikes wide. So let's just do example because it closed at 40.57. Let's look at a round number of that 40.60. 40.60. And this is doing credit spreads. You're doing options, but credit spreads and time decays in your favor. Short strike 460, long strike 465. That's 1 strike wide. Hear me, 1 strike wide, 5 points. Yep. This is the S&P 500. 1 point represents $25 price fluctuation. So again, when we're looking here, the 40.60 and 40.65, that's 1 strike wide, 1 strike, 2 strikes, 3 strikes, 4 strikes, got it? But it's 5 points. 1 strike wide, 5 points wide. And each price fluctuation will be 20-point value, $25 value. And that's because it's a credit spread. That's what you would have collected, $205. Well, every SPX 5 wide is $500 margin. So that's how much you need minimum to trade this one. Again, it's just representing one, minimum $500. You have $500 you're collecting, $205. I'll show you a little bit more detail. Click on this. So the max profit you can make is $205 right there. Max profit, $205. Max loss is $295. But I told you it's $500 margin. It is. You need $500 margin to trade this. And when you select, if you select these strikes that are much closer to the underlining, you're collecting a higher credit. We'll add that together, $205, $295, it's $500. $500, but you're getting a credit $205. And if the price goes lower from 457, this melts away and you're making gains. Again, you have to close it or let it expire without getting tested. This short strike, you don't want to be tested. So good money management, maybe you're closing at 30%, 40%, 50%. But the point is, as you get closer to the end of the day, or as the stock moves lower, because this is a bear call spread, this would melt away, you'd be having the credit. Okay, let's look at something more aggressive, or less aggressive. Sorry, that's very aggressive because that was the 460 strike. Let's look at something lower risk. Let's go all the way down here, 16 delta, 16 delta. Same strategy, 1 strike wide, 1 strike, 2 strike, again, 5 points. Well, if you notice, 4105 versus the other one was 460. Well, 460 strike, the short strike, was closer to the here, 457. This 4105 is further away. Because it's further away, you're collecting less money. The margin's still the same. Still $500. So 425 plus 75, 500. So you still need $500. But now the max you can make is 75. There's one of the difference, you understand? So if you're getting closer to the underlining, as we did the first short strike, potential to make more money, but the margin's still the same. But again, there's more chances things go against you too. Yeah. Let's do this to even lower risk. Lower risk means further away. Let's go all the way to the 10 delta. Again, same thing. Credit spread, 420 short, 4125 long. When I say short, you're selling that strike. See that says sell over there, sell the 4120, you're buying the 4125, which is giving you a credit. Well, how's that giving you a credit? Well, the short strike versus the long strike are different premiums. And the one you're selling, the short one, 4120, is a higher premium. So the higher premium up here, see the bid and ask, 195, 190. Again, these are not valid anymore. The market's closed differences. So, but here the point is, again, you're collecting less money. You're only collecting 35. Max profit, 35. Max loss, 465. Yep. So the max loss goes up and the max profit goes down. But the point is, the margin's still the same, depending on where you want to be with a short strike. The other thing is some brokers may charge 0 commission. Some brokers may charge commission on opening, close trade, or closing the trade. Then there's the exchange and the regulatory body that charges fees. It's not free, and you can check and verify different brokers if they charge commissions for each option leg, what's the regulatory fees, what's the exchange fee. So just because they say zero commission in their ad, there might be a little asterisk or star denotating that there's other fees involved. Yep. Going forward, back to the chart. Now I'll take you to the 30 minutes. SPX, the 30-minute candles. And we're also going to see the 15-minute candles. So here, we're looking at 5 days, the past 5 days. This light gray vertical area, that was the market hours that were closed. I'll use multiple time frames. One of them is the 30-minute, and you're also going to see the 15-minute and other ones I use. So looking here, the first 30-minute, that'd be the 9:30 a.m. to 10 a.m. The candle closed red, huge body, huge trading range, little till. Second candle, second 30-minute one, that would be the 10 o'clock, 10:30. Big red body, little till. The trend is down. Nice. Looking here, the next day, the first two 30-minute candles, both green, smaller bodies. Second one, huge till on top. That's suspicious. Let's go here, the Wednesday, smaller green candles, smaller bodies. But again, higher high, higher low. These green candles, higher high, higher low. Look what happened here. The third candle sold off, went lower. Here, on Wednesday, the third candle was an inside candle, eventually going higher. Thursday, first two 30-minute candles, green. First one, big body. Second one, smaller, big body, but the trend is up, reverse. But look at Friday. First one, red candle. Second one, red candle, made a higher high. And then huge trading range down. Continue going red rest of the day. Easy to be faked out. So maybe if you just were using that first candle alone, you could have been misled. Maybe this first candle, you were bearish, bear call spread up here. Down here, maybe the first, second candle, you did bulk put spread. Maybe here too, maybe here too, maybe here too. Well, on this Friday, huge trading range. These other days, you could possibly trade both sides. Both sides, yeah. And the good thing is, if you do both sides, you're only paying margin once. You're doing both sides, but only one side is at risk getting tested. Both sides can't be tested simultaneously. So you don't have to have $1,000. Nope, you could just do $500 and still do both sides. Yeah, you're exposing yourself to risks if you're on both sides here, if you got tested. What I like to see is these huge bodies, trading range with a very small wick, and see what happens the second one to give more confirmation which direction I should be trading. Also looking at the 15-minute candle. Okay, now we're on the same thing, 5 days, but looking at the 15-minute candles. So looking here on Monday, again, two 15-minute candles make up a 30-minute candle. So the first four here represent the first two on the 30-minute. Well, maybe I could see something ahead of time on the 15-minute that I won't necessarily see on the 30-minute till after the 30 minutes done, using combination time frames. And here Monday, again, the first four candles were red, lower low, lower high. Give me a bearish bias, identifying maybe I should be trading bearish. We'll look at here Monday, Tuesday, the first trading candles, the first four 15-minute candles, first one red, second and third green, the third one inside. Suspicious. Well, nothing wrong sitting on hands or taking it to the back to the higher time frame. So now we're looking at the 30-minute time frame again. Look at this second green candle, bearish pin bar. Much more identifying that, hey, it's probably bearish. I'd be doing bear call spreads, because if I do bullet spreads, yeah, we made higher highs, higher lows. But if I do bullet spreads, I might be tested on the downside. So again, looking back here on the 15-minute, look at that fourth 15-minute candle, inside candle, solid body, pretty big. Give me a clue of the potential reversal. I could wait for a breakout to the upside or downside. Well, I'm going to zoom in here. Look what we did. We didn't break out to the upside. After this fourth 15-minute candle got done, we broke to the downside. So if you understand how to use inside candles with a combination of other things, you might say, hey, look at that double top of that. I should be going bearish, trading bearish. Take this back to the 30-minute. Yeah, if you traded bearish with strikes higher above here, you could have stayed until expiration and made max profit. If you stayed at expiration, some brokers that charge commissions on both sides, you wouldn't have to pay any fees. And some exchange rates, you don't have to pay on the closing of it because you let it expire. So what that means is you pay less fees and you're keeping more profits. Plus you let it expire. You kept all the credits. Yeah, there's risk to this, understand that. The point is, we're looking at multiple time frames and how easily it could have been fooled saying, okay, green candles, first two 30-minute candles, higher high, higher low. I should be going long. Well, if you did, again, understand that rolled over, went lower. And that 15-minute gave me some better insight combining them both. So finally, let's look here on Friday. Look at that first candle, huge tail on the bottom, the first 30-minute candle. Second one, bigger tail on the top, sold off. Well, maybe I didn't have to wait till that second 30-minute candle got done. I might be looking here at the 15-minute candles saying, wow, first 15-minute candle, second, third. Seeing that they're all rejecting this big round number, 4,200, 4,200. And this other one had a huge body. So am I saying, hey, I understand, huge whipsaw, but it's rejecting up here. Maybe I'll do bearish. And then when you're looking at the 30-minute, first 30-minute, might be saying, wow, look at that too. And all of a sudden, the second 30-minute takes out that low. Yep. So these are just some of the things I'm looking for when I'm considering what strikes to take and what direction to take. Nothing wrong also adding more positions if you're confident in your direction, as well as you could come back and do this in the afternoon. Some people only do this in the morning. That's fine. And some people do it only in the afternoon. They might come back 2 o'clock, 2:30. As well as some people may do it both sessions, morning session, afternoon session. The point is, understand this financial instrument trades 9:30 a.m. to 4 p.m. New York time. I'll discuss other S&P 500 trading financial instruments in the futures market and other stock ETFs. Many thanks for watching.